how many losing trades have you taken on crypto recently? Like, I mean, I've been following you guys. I don't remember a losing trade, to be honest.
No, I think I've had 3 losing trades since November of 2021 out of about 100. So
What? Right, hello and welcome to Camel Finance. I'm your boy Camel, and apparently I don't know what I'm talking about. Allow me to explain. You see, what I thought was going on was we were swinging from a highly inflationary environment towards deflation. And whilst there are a bunch of reasons for this, the primary reason was that I happen to know the M2 rate of change lags manifestation in the US CPI by around 18 or 19 months. Since we had had a huge snapback, a sideways wobble, and then a final leg down in the M2 rate of change, it was my expectation that we would see a move down, a sideways wobble, followed by one final leg down into deflation for the CPI. Whilst we're in the middle of this Goldilocks zone and inflation is coming down, I hypothesized that from the lows, we would see this big blow off top melt up to new all-time highs before deflation actually sets in and the pendulum reaches the far left-hand side of the screen, and we went into a deflationary bust and a global recession. And whilst you might look at this chart right now and think that doesn't seem like a particularly contrarian or outside-the-box idea, it's important to keep in mind that this call was actually made down here at the lows when every man and his dog was doom posting 2008 style fractals and expecting a huge stock market crash just like we had back here in the GFC. Not only did we make this massively contrarian and outside the box call at these lows, we then followed the market and said that this thing would be back on if indeed we printed a higher low, and of course that is what we did. So indeed, this was a highly contrarian, highly outside the box idea at the time it was proposed, as well as me saying that we were probably going to have an early blow off top for Bitcoin. Again, at the time this call was made, it was a highly outside the box and contrarian call. The entire time I've had the channel, and for many years now, I have been using Trueflation to track the direction of CPI. As I said at the start, the M2 rate of change went down, sideways and down, and we know this lags manifestation in the CPI print, and we had only seen so far down and sideways. Thus, I was expecting to see that final leg down towards deflation, and having been tracking Trueflation in order to gauge the trend, we had managed to see down, sideways, and then at the hard right edge of late, a move down. All of this kind of said to me that I did know what I was talking about and I was going to be right about us moving towards deflation, particularly as this seemed to be confirmed over in China. China entered deflation, and the next thing you know, the stock market starts tanking, just as my expectation in my yellow squiggle suggested we might. So all seemed right with the world, up until, of course, the beginning of this week when CPI came in far hotter than expected. We also then had to close the week out hotter than expected PPI data, which of course begs the question, is the data wrong? Or am I wrong in my analysis? A couple of things that are important to point out is Trueflation had not let me down until this week. But entering this week, we had Trueflation on a 1.3 something, I think it was about 1.34, and even to this day, despite modifying us back to 1.7, the government reported rate should read 3.1, not 3.4. So is the data wrong, or am I wrong? That is what we're going to try to work out. I do think it's worth pointing out that the CPI came in stronger than expected this week, of course, and most people seem to think that inflation is due a spike back up or is at least going to be sticky for the foreseeable future, and that the Fed should not be in a hurry to cut rates. However, the CPI details don't really suggest that. Whilst headline CPI came in at 3.09% year over year and core at 3.86%, what's strange about the CPI is consensus estimates came down inexplicably the day before the release, almost as if the market wanted to sell off based on the CPI miss. Headline CPI came in hot too, however, this is all about seasonality. Between January 23 and January 22, headline CPI was plus 0.8% month over month, whilst between January 21 and January 2020 it was plus 0.4%. So remember that between 2020 and 2021, the Fed didn't even think about worrying about inflation. So did CPI headline accelerate in January? Not really. It actually came down a lot from the plus 0.8% month over month in the prior two Januaries, now sits at plus 0.5%. And the same is true of core CPI, again, with a lot of it being due to seasonality. So it begs the question, what exactly is causing the hotter than expected prints? And if you've been following CPI, you will have guessed this already. Again, it is shelter. Shelter accelerated from 0.4% in December to 0.6% month over month in Jan. Which is weird because at the same time, other rent measurements like ALNRI continue to show strong deflation. So if shelter was left at plus 4% in Jan, both headline and core CPI would have been plus 4%, which is exactly where we had it in January 2020, prior to the first lockdowns before the whole inflation mess began. But here's the best part. If shelter was 0, both headline and core CPI would have been much lower, roughly around pre-2020 levels. But shelter shouldn't be 0. It should be negative to match the real rent inflation in Jan, like the ALNRI data. So shelter is a flawed statistic reflecting what happened with rents 15 plus months ago. When rents are volatile, it never shows the actual rent inflation, overstating it during disinflation and understating it during inflationary periods. So the CPI report shouldn't worry the Fed too much. After all, headline year over year came down quite a lot, and core also showed some progress. And so this is likely the reason that whilst we got a sell-off on the initial surprise to see a hotter than expected print, overall, the markets have finished the week rather strong and convincingly. So the question is, what can we do now? And unfortunately, the answer is, all we can do is wait to see another print. If what happens over the next month is this continues to go down, then I can continue to accept my primary hypothesis, which of course is that we are going to see this final leg down in the M2 rate of change manifest with its lag in the CPI print. We are indeed going to swing towards deflation as expected, just like we've seen in China, and that will ultimately culminate in this deflationary bust and a global recession. That is one possible outcome. Of course, the other possible outcome is that what we start to see now is this creep up or inflation be sticky, back-to-back prints around the 3 neighborhood would not be a good sign, would be starting to tell me that I'm wrong about seeing this slip down towards deflation, and thus we may have to readjust the hypothesis walking forward. We may have to be ready for a more sticky inflationary environment than we are currently prepared for. There is, however, more light at the end of the tunnel, because the VIX, also known as the fear gauge, closed in the 13s after 2 higher than expected inflation reports. Does not speak to a volatility event or a stock market collapse any time soon. There is more silver lining to these dark CPI clouds in the form of liquidity, because despite the Fed beating the drum of restrictive monetary policy and higher for longer rhetoric, under the hood, conditions are not actually restrictive and are far more accommodative if you know where to look. This is because the financial system continues to experience an influx of liquidity rather than an outflow. Since tightening began, the Fed's balance sheet has shrunk by around $1.24 trillion. But during that time, the reverse repo has dropped by about 1.38 trillion. So it's crucial to understand that Powell is not shrinking the balance sheet as quickly as Yellen is expanding M2. What is essentially happening is that the reverse repo cushion is absorbing the expected liquidity drain from quantitative tightening, which is net liquidity positive. So there is still liquidity in this market. We are still in net accommodative and stimulative conditions despite all of this higher for longer rhetoric. So the melt up is alive and well. But the real question is, what happens when that reverse repo cushion is gone? And more light at the end of the tunnel in the form of rate cuts, because as it stands, rate cuts have been taken off of the table for March's FOMC. When we click out to May, it also seems that we're going to continue to remain paused at May's meeting, and that we're likely not going to see any rate cuts, assuming nothing breaks in the meantime and forces the Fed's hand, until at least the June meeting. This gives us the space to continue to rally. As we know, based on historical data, the market can tolerate somewhere between 0 and 2 rate cuts before the top comes in for the stock market. So the further they push these cuts back, the more gas there should be left in this goose, and the more space the markets should have to have their blow off top moment into new all-time highs. So in the short to medium term, I think we can run these things hotter. I think we can continue to see more bullish price action across the board. But with all of that said, a recession does seem to be incoming. As I said, we've seen China enter deflation already. Japan has entered a recession. The UK has entered a recession. Germany is teetering on the edge of a recession, just to name a few. There are many leading indicators pointing to a recession brewing, albeit not right away. Henrich's leading recession indicator has never produced a false signal in 80 years of backtesting. It has produced a signal here which tells us to be open to seeing a recession within the next 12 months. We have also seen the yield curve revert and start to push up. Historically, once we get up into this neighborhood, we could expect a recession to set in, similar to here, here, and here. We also have this huge negative divergence in industrial production, just like we had before the GFC. And again today, we have this same negative divergence brewing, potentially before we see this recession setting in. In the blue here, we have the housing market index. Again, if we look back to the GFC, okay, here, down, counter trend bounce before new lows, recession sets in, all of this with the unemployment rate rolling over. At the hard right edge, what do we have? Down, counter trend bounce, looking for those new lows as the unemployment rate in orange is rolling over. Again, the parallels are starting to become more and more visible. And fitting in with this theme of drawing parallels to 2008, we also have jolts rolling over right as the housing market does this, and we get this spike in inflation before a move into deflation. What do we have at the hard right edge? Jolts rolling over, housing market doing this, the spike in inflation that we've already seen as we move down towards deflation. So this idea that we are going to move into deflation, this idea that the pendulum is going to swing back towards deflation, and the idea that all of this is predicated on the fact they overstimulated and then had to have this snap back on the way down, which of course lags in the CPI by around 18 months, is not yet off the table. As I said before, if we start to see this look at the hard right edge, we start to see inflation actually be sticky, then we will be forced to reassess the situation. But for now, it seems like there is more gas left in this goose. It seems like there is a run to all-time highs, and it seems like Bitcoin has a catch-up trade left in it. Speaking of Bitcoin, people are starting to believe there is more and more optimism coming into this market, and people are starting to believe that this rally could well be for real, in line with, of course, the Wall Street cheat sheet. People I know are underallocated because we did a live stream yesterday, and they were asking me, what do I do if I'm underallocated? Based on this 618 retracement breakout that we are seeing at the hard right edge, you can see that the thing has only just started what it has done in previous cycles. So it is certainly not too late to get into Bitcoin here. However, as always, risk should be managed accordingly. And a lot of the reason that Bitcoin has been doing Bitcoin things lately is because these ETFs are slowly but surely hoovering up the entire available supply, which is now sub 2 million coins if we exclude miners. The reason I'm happy to exclude miners is we know that the institutions are buying them and the miners are in net accumulation rather than net distribution. So there's just simply not enough Bitcoin to go around. BlackRock has already hoovered up $6 billion in its iShares ETF alone. And when we price Bitcoin in other currencies, here it is against the euro, you can see that it's not that far from all-time highs now. The same is true of the GBP. As you can see, not that far from all-time highs. If we click into the Russian ruble, you can see right around 8% away from all-time highs. Against other currencies, such as the South African rand, we are at new all-time highs. And against many currencies that are significantly weaker, such as the Argentine peso, Bitcoin has done what it was intended to do. So this week is going to be huge because we're going to get an answer on the dollar and the dollar basket. Can the dollar do what I wanted it to do, which is have this deviation into CPI, reject a resistance, roll over, and then come down here to find a 3-year cycle low somewhere around the 95 range? Of course, if we can do that, that should be conducive to a huge blow off top, risk on moment across all risk assets. Bitcoin continues to do Bitcoin things, and we continue to push both of these positions until we can find another place to add more. The crypto-related equities, we continue to push all the positions across all of those. Of course, they continue to do Bitcoin things as well. The stock market closed the week above major support. We've been using this red line as our line in the sand to take the profit on both of these trades, and the Nasdaq as well continues to hold support. So lose this week, and we will be closing these and sitting on the sides waiting for the next cycle lows to show up. But as you can see, so far pushing the trades has been the correct call. The Russell 2K not only holding its upward sloping red support line, but also now closing right on the top of the range breakout here, tells me at least to keep an open mind about better than expected outcomes and breadth starting to widen as we enter berserk mode and that blow off top moment that I've been talking about ever since the lows back here. If my deflation idea is correct, we should see oil come off strongly. We're expecting to see this yellow squiggle play out, a breakdown of this upward sloping red support line, and if that is the case, we will re-enter back short here again and be targeting around $40 a barrel for oil. That is not a popular call at the moment, but that is how I like them. It's also worth noting gold behaving exactly as we wanted to see it behave, right? We found a daily cycle low. We're getting that counter trend bounce. In an ideal world, we will make this counter trend bounce, touch this red support and reject. And as we do that, it will be my entry for a short, targeting at least the weekly cycle low down here, if not below that. So overall, the same principles apply. Long and strong, continue to push. Take things one day at a time, see what the market will give us. If we start to lose supports, we have the cycles as context. The cycles will tell us to sit on the side, take our profit and wait for the next high probability setup. Thank you for everyone that attended the live stream yesterday. I had a blast. In the meantime, if you're a member, level 3 member, look out for the members only deep dive, which I'll be posting after this. And to everyone else, I hope you are doing well in life. I hope you enjoy your weekend. And until next time, take care from me. All the best. Cheers. Bye.